Hi, I'm going to give you an update on the RECM Balanced Fund and in particular talk about the last quarter, how things played out in the markets, how we were positioned, and of course how we're positioned going forward as well. So looking at the last quarter, it was an interesting one for global markets versus the local market. The local market was in fact flat, whereas the global market was up quite strongly. And in fact, many emerging markets actually rallied very strongly. And they're largely as a result of the commodity cycle and the resource stocks continuing to rally, and a lot of technology stocks also performing very well. And that did filter somewhat into the South African equity market, where we saw businesses which have got global technology exposure or emerging market technology exposure, such as Naspers with Tencent and Mail.ru in Russia, performing very well as well. But unfortunately for the South African equity market, the Rand strength was actually a dampener, and we saw a lot of Rand hedge businesses underperforming. The good news for RECM Balanced Fund investors is that that was a very positive thing for our fund, and there does seem to be a bit of a turning in the tide, which is starting to favor value investors, which has obviously been quite different to what the market environment has been over the last few years, which has been very much a sort of momentum growth oriented environment. So the fund is actually up over 20% year to date, which is obviously a reflection of how we positioned, particularly with regards to our exposure to the resources sector, which has obviously had a huge turnaround in performance for the year to date. As a result of that, we have trimmed back some of our exposure in the sector, but it's still very meaningful in the fund in terms of the percentage relative to the overall equity component in the fund. Obviously, the fund does have exposure to the global market through its exposure to the RECM Global Fund. Here we did have some action where we deployed some of our global cash into new investments. Some of those included things which are not directly in the resources sector, but actually sort of tangentially related to the resources sector. And you will probably remember that last quarter we spoke about businesses such as Alfa Laval, Agreco, Rotork, which are all industrial businesses, but they actually supply services or specialist parts to energy producers or mining producers. And as a result, they have sort of seen their share prices come under pressure as well. So high quality businesses which are undervalued, those have been the sort of new names that have come into our global component of the RECM Balance Fund, and also some exposure to the luxury segment. So over the last quarter, we introduced a little bit of exposure to businesses such as Swatch, Hugo Boss. We do already have exposure to Richemont, and we are sort of taking advantage of the fact that luxury goods have come under a bit of pressure as a result of the slowdown in economic growth in China, less travel because of terrorist attacks, and of course emerging market currencies being very weak rather relative to the dollar. So you'll see some of that exposure creeping through in the global segment. Locally, we have started to shift more towards domestically oriented businesses. You would have seen over the course of the last year that a few of the construction stocks had crept into the portfolio, and that's obviously been a good thing for the portfolio over the last quarter because you've had a big rally in those stocks. So the sort of construction index locally is up over 10%. I think it's around 11% for the last quarter, and our exposure to businesses like WBHO, Robex and Avenge has obviously been a boost to returns as well. So we've pulled back some of that exposure as a result of those prices rising, but we do still have sort of a bit of a tilt towards the more domestically oriented businesses, which have been out of favor, and less towards the Rand hedge businesses outside of the resources sector, obviously, which have obviously had a huge tailwind in the form of the weakening Rand, those sort of quality Rand hedge businesses which have done so well over the last few years. So if you look at the top 10 stocks in the RECM Balanced Fund, you can see that it is still, as I say, very much exposed to the resources industry. But over the last year, you've really seen the portfolio become a lot more diversified. And that's obviously always preferable and something that you really need to be offered to you in terms of the opportunity set that the market is providing. So 2 years ago, it was really only the resources sector that was significantly undervalued. Over the last 2 years, other segments of the local market and the global market have become cheap. So we've been able to actually sort of move into other areas, which obviously obviously gives a far more sort of balanced and diversified portfolio overall. We do still have a lot of cash in this portfolio. What that reflects is that we do have a preference for quality businesses, with the proviso that obviously to have a significant position in them, they have to be cheap. So our positions in the higher quality businesses have been smaller than we'd like because they're not cheap enough yet to actually justify larger positions. And the sort of lower quality businesses that are cheap are ones that we would never really have big allocations to. So we want to take advantage of those opportunities, but we don't want to overly expose the portfolio to lower quality businesses. We want that balance to tilt more towards quality businesses. So we're still sitting with 40% in cash. I think that's actually a very desirable position to be in, because you want that dry powder to actually put to use as the volatility, the negative sentiment, political turmoil, all these things contribute towards sell-offs and short-term volatility in the market, which obviously provides savvy investors with the opportunity to buy businesses at good prices. So overall, I think that there has been a turning of the tide. There is definitely, we believe, a bit of a shift towards value investors. We think that there's a long way to go in that value cycle, and we think that patient and value investors will ultimately be very handsomely rewarded for staying the course. Thank you very much.